Good day everyone, I'm Ronica May A. Cantos, the first reporter of the group, and I'm about to discuss the definition, uses, and advantage and disadvantage of a stock index future. So first, let me define stock index future. Ano nga ba ang stock index future? So, stock index futures are legal agreements to buy or sell a contract derived from a stock index on a future date at a specific time. So, stock index futures are derivatives, so no actual stock change hands. Instead, yung buyer and yung seller enter a contract with each other. Each investor ay magbabayad ng margin to a broker. Ito yung amount na kailangan mong i-deposit to maintain the future contracts. This is a percentage of the value of your transaction. When the contract is entered, both parties agree to pay the difference of the index movement between the day the contract was entered and the settlement date or the expiration date. What are stocks index used for? Stock index futures are used for a variety of reasons. The most common reason is that traders are speculating on which way the market will move in the future. So similarly, speculation on asset. If a market trader believes that the index will increase or magiging successful in the future, then the trader will buy the stock index futures. Second, if index future can also be used for hedging purposes. So, if yung investor is holding a portfolio na parehas or reflective of an index, buying or selling index future can be used to offset or cancel out the potential losses their portfolio may face. For example, farmers. Farmers use these contracts to protect themselves from the risk of a drop in corn prices. Assume a farmer is planting grains and expects collecting 8,000 tons of grain when the plant is ready. So she can sell the entire crop at a fixed price well before the actual harvest, with delivery scheduled for a future date such as 5 months from the date of agreement. If she is unsure of the prices at the time of harvest, although the farmer does not receive the sale proceeds at the time of the agreement, the transaction protects her against currency exchange rate fluctuation and price drops in the global market. Third, index futures are used as a spread or relative value trading tool. This is a position that involves taking a long and short position on index futures. This trade is done with a focus on the spread or the difference in the prices of the related securities. This trade will attempt to a net profit from the widening or narrowing of these prices rather than a change of the index as a whole. Advantage and disadvantage of a stock index futures. First advantage is you can speculate on future stock prices and give them more leverage. So, investor with good knowledge and judgment skills can make more quickly in future as compared to normal stock trading. For example, consider the fluctuation of the price of commodity like gold. A future trader can potentially profit by correctly guessing the direction that the price of gold will increase. So, dito na papasok yung disadvantage. So, because of the high leverage, your losses will be substantial if these futures do not move as expected. It's easy to wind up highly leveraged and lose your entire investment when market conditions go against you. For example, if the future trader guesses wrong, he can lose his entire investment. So, traders must need to be very attentive and utilize the favorable price movements in timely manner.
Good day everyone, I am Rachel Pontanilla and I will be talking about hedge and arbitrage. It can be hard to look away when things are bumpy. It's easy to become obsessive when things to start slide in times like this of us probably wish that we could insure our investment against downturns. When people decide to hedge, they are insuring themselves against a negative events impact on their finances. This doesn't prevent all negative events from happening. Hedging is a risk management strategy employed to offset losses in investment by taking an opposite position in a related asset. The reduction in risk provided by hedging also typically result in a reduction in potential profits. Hedging. When we hedge an investment, we reduce or eliminate certain risks that could negatively impact our holdings, including but not limited to stock market crashes as a whole. It's a popular practice some funds know as hedge. Hedging strategies typically involve derivatives such as option and future contracts. With derivatives, you can develop trading strategy where a loss in one investment is offset by gaining a derivative. The example of wheat producer and cereal manufacturers hedging their exposure to fluctuation and wheat prices. As we know, wheat is susceptible to significant fluctuation in their price owing to both supply and demand. Fall in the price of wheat is bad for wheat producer because they can get less money from the crops, but it's good for cereal manufacturer because they can get one of their key input at a discount. On the other hand, an increase in the price of wheat is good for wheat producer because they can get more money for the crops, but bad for cereal manufacturer because it increases cost. So it is in the interest of wheat farmers that the price of wheat remains high, but it is in the interest of cereal manufacturer that the price of wheat remains low. Now, if a wheat producer expects that the price of wheat is about to fall and cereal manufacturer is the opinion that the price of wheat is about to rise, the two parties can enter into a contract fixing the future contract and the future price at which the wheat will be sold. Wheat to manufacture in 6 months at the current price of 600 pesos, regardless what the market price for wheat in 6 months. By locking in the price of wheat, the producer is seeking to protect his or her against expected decrease in the price of wheat. On the other hand, the manufacturer is seeking to protect his or herself from expected increase in the price of wheat. If the price of wheat falls, the cereal manufacturer or buyer will wish that they hadn't signed the contract because they'd be buying wheat for cheaper had they not signed it. Conversely, if the price of wheat rises, the producer or seller will wish that they hadn't signed the contract because they could sell wheat for more money had not agreed to the contract term. Because the price of wheat can only move into two directions, which is up or down. This example is a zero-sum game processing both distinct winner and a distinct loser. Basically, the interests of the wheat producer or the cereal manufacturer can be met, not both. But the most important to take away from this example is that derivatives can be used to hedge risk. In summary, every hedging strategy has a cost associated with it. So before you decide to use hedging, you should ask yourself first if the potential benefits justify the expenses. And remember, the goal of hedging isn't to make money. It's to protect the money from losses. Arbitrage. Arbitrage is an investment strategy in which investors simultaneously buy and sell an asset in a different markets to take advantage of a price difference and generate a profit. While price differences are typically small and short-lived, the return can be impressive when multiplied by a large volume. Imagine we are living in a city. A city has two markets which are Market A and Market B. Sa Market A, binebenta nila yung berries sa halagang 450 pesos per kilogram. And just down to the street, sa Market B, binebenta naman nilang berries sa halagang 500 pesos per kilogram. However, most people buying berries in Market B at hindi nila alam mas makakabili sila ng berries sa mas murang presyo sa Market A. Kung hindi nila alam, syempre pupunta ang mga tao sa Market A para bumili ng mas murang berries. The difference in prices is because of imperfect information. As a smart businessman, you decide to take advantage of this. So every morning you go to Market A to buy the berries at a cheaper price and go to Market B to sell the berries at a higher price. For every kilogram of berries you sell, you can earn a risk-free profit of 100 pesos from the price difference in the market. In fact, in the next few months, you became so successful that you started buying a large quantities of berries in Market A and selling them in Market B. This affects the demand and supply of berries in Market A and Market B respectively. The demand of berries in Market A increases, so their price increases in Market A, and supplies of berries in Market B.
Good afternoon, everyone. I'm Maria Nina Irvidera, and I'll be discussing hedge funds. To start, hedge funds is a pool of money investors put wherein a fund manager can draw from it to use it to buy and sell assets. Meaning, ang fund manager ang bahala kung saan niya gagamitin yung fund. Pwedeng ipambili ng real estate or pwedeng invest in small startup like Shark Tank. A hedge fund also goes and trades with public securities like stocks, bonds, crypto, derivatives, or anything that is available in the public market. So let's have a little background about the history of hedge funds. So in year 1949, the formulation of hedging fund idea took place. During this year, banks dominated the economy, and the primary way that people invest is through banks and running a mutual funds. However, the disadvantage of mutual funds, aside from it does not diversify its funds, it also requires and charges large fees in order to invest in them. So, Alfred Winslow Jones, an Australian sociologist, then later on considered as the father of hedging fund industry, found a particular idea that he can diversify high investments in which it has a different risk adjustments of return. He also concluded that with mixing up portfolios with assets that are contradicting to each other, he can get more return in a lower risk. Going forward in the year 1952, fees and leverage are born. Jones created the first hedge fund product, and he also added an incentive fee and converted his fund into limited partnership. The leverage fee he set is 20%. In the year 1960s, this is considered as the rise of the hedge fund. When hedge funds completely took, 100 different hedge funds has been launched, featured in various articles, and outperformed the best mutual fund by 44% over its prior years. In year 1970s, ito naman ang tinaguriang the first hedge fund crash. The market crashes in 1973 to 1974, which resulted in many hedge funds closure as the industry struggled against market risks. Jones' fund itself lost over 10%. However, in the 34-year lifespan of Jones' fund, he already made losses in 3 years. So in 1980s, the hedge fund research. It continued to evolve over 1980s. The changing markets of the 1980s provided many opportunities for hedge funds. In 1990s, the real hedge fund booms. Dominant funds were launched including Bridgewater Associates, Steve Cohen's SAC Capital Advisors, which is today called as Point72 Asset Management, and John Paulson's Paulson & Co., and etc. This era was defined not only by the emergence of a superstar managers, but also by an explosion of new strategies within the hedge fund sector. Lastly, the year 2000. This is considered as the moving into the mainstream. Institutional investors such as pension funds, insurance companies, and sovereign wealth funds made their first investments in hedge fund products. So here are the top 5 hedge funds as of today, namely Bridgewater Associates, Renaissance Technologies, Man Group, Millennium Management, and Elliott Management. That's all for my report. Thank you very much for listening.
Good evening, sir and classmates. My name is Andrea Noel Tolentino, and I'm going to discuss the difference of mutual funds to hedge funds. First, let's talk about the mutual funds. A mutual fund is a company that brings together money from many people and invests it in stocks, bonds, or other assets. The combined holdings of stocks, bonds, or other assets the fund owns are known as its portfolio. Each investor in the fund owns shares which represent a part of these holdings. So basically, ang mutual fund ay isang investment kung saan maraming tao ang nagtitipon-tipon ng money para mag-invest in assets like stocks, bond, and money market. Ang mga funds na ito ay pinangangalagaan ng mga professional na money managers at ang layunin nila ay invest ang resources ng fund upang kumita ng pera para sa mga shareholders. How about the hedge funds? Hedge funds are actively managed investment pools whose managers use a wide range of strategies, often including buying with borrowed money and trading esoteric assets, in an effort to beat average investment return for their clients. They are considered risky alternative investment choices. So, ang hedge fund ay isang pondo sa pamumuhunan na binubuo ng kapital mula sa mga pinaniwalaan na individual o mga namumuhunan sa institusyon at namumuhunan sa iba't ibang mga asset. So, what's the difference between mutual funds and hedge funds? Mutual funds are regulated investment products offered to the public and available for daily trading, while hedge funds are private investments that are only available to accredited investors. So, hedge funds are managed in a much more aggressive fashion. Unlike mutual funds, hedge funds take speculative positions in derivatives and they short sell stocks. With increased leverage comes increased risk, but also the chance to gain when the market is falling. Mutual funds are safer, but they won't take highly leveraged positions. Hedge funds are only available to accredited investors who must meet a specific set of criteria to qualify. They are sophisticated investors with high net worth. Mutual funds are easy to purchase with minimal cash. That's all for our report. Again, we are Group Supectibol. Thank you for listening and have a good day.